Everyone talks about accelerated depreciation and locking in huge paper losses. But when is that actually true? And what do you really need to do to pull it off? Let me show you exactly how it works and how skipping one tiny step on the return can cost you hundreds of thousands of dollars in year one deductions. And it's the type of mistake that cannot be amended retroactively. Once it's missed on the original return, you are done. And I'm Jasmine DiLucci. I'm a practicing tax attorney, CPA, and enrolled agent. I got my first tax license in high school, and in today's video, we're going through the real tax law on accelerating real estate depreciation, not the fantasy version sold to you by real estate gurus pitching their latest course or investment. In this video, I'll break down 4 things. First, how depreciation really works. Second, what a cost segregation study is and why it can supercharge your year one tax savings. Third is the one-page piece of paper most accountants skip on your return, and when left off, it destroys your entire depreciation benefit. And finally, how tax-savvy investors structure real estate to lock in permanent tax savings year after year. First, how depreciation really works. When you buy real estate legally, you're not allowed to deduct the purchase price all at once, right? Since you've purchased an asset, instead you get to take a tax deduction called depreciation, which is a way of recovering the cost of the building slowly over time. So here's the rule. Residential rental property has a 27.5-year recovery period. Commercial property has a 39-year recovery period. So if you buy a $1 million commercial building, you don't deduct $1 million in year one. Instead, maybe $200,000 is for land, which is not depreciable, leaving $800,000 as a depreciable asset. That gives you only about $20,000 a year in deductions every year for nearly 4 decades. That is painfully slow, especially when you're trying to reduce taxable income today so you can take that money and invest it in more assets. And that's why investors look to accelerate depreciation to take the deductions when they're most valuable. Second, let's get into it, okay? What is a cost segregation study and why does it matter? It's an engineering-based analysis that reclassifies part of your building into shorter-lived assets. For example, if you have a $800,000 building value, then a cost segregation could identify, for example, $100,000 as 5-year property for equipment, appliances, and flooring, $140,000 as 15-year property for parking lots, landscaping, and other improvements, leaving only $560,000 as 39-year structural building. Here's the key. Property with a life of 20 years or less qualifies for bonus depreciation under IRC 168K. So instead of just $20,000 in year one depreciation, a cost segregation can generate $240,000 of immediate deductions. That's the huge paper loss that everyone talks about. And when done correctly, meaning the loss is classified to match the type of income you need to offset, whether passive or non-passive, it can wipe out taxable income and slash your year one tax bill. All right, third, let's go through the tiny step on your return that most accountants and definitely most self-prepared returns miss. And this is where it unravels fast, okay? You've heard you can save big with real estate paper losses. You even invested in a cost segregation study. You're thinking you're all set, okay? But then your attorney correctly tells you to put the building in a separate LLC and lease it back to your operating company. Legally, that's smart for asset protection. But tax-wise, it creates a trap. The IRS now sees 2 separate activities, okay? The self-rental activity, passive if it shows a loss, and the operating business, which is active. Okay, and without the election, the IRS treats those activities as completely separate, which means all of those accelerated depreciation deductions from your cost segregation don't reduce your business income at all. They get trapped as passive losses, and passive losses can't offset your active income. They just sit there suspended until you have passive income or sell the property. This is exactly what happened to one of my clients before becoming a client. Okay, the accountant filed the return, skipped the election, and suspended $200,000 in first-year depreciation deductions after having the client perform a cost segregation. And the worst part, you can't fix it later. Okay, the grouping election must be on the original return. You cannot add it later to change the tax treatment from passive to active. The fix is simple, okay? You check a box inside the tax software that elects to group the activities allowed under the Treasury regulations, okay? It is a 1-page statement added to the return that says you're grouping the rental in the business as a single economic unit based on common ownership, control, and interdependence. With that election, your rental losses offset your active income, miss it, and your deductions disappear. Finally, here's how savvy investors create permanent tax savings from real estate. Okay, they time cost segregations strategically, using them in high income years when the deductions really matter. They pair cost segregations with the right elections like grouping for self-rentals and real estate professional status, or even with short-term rentals where they materially participate so the deductions can actually be used instead of suspended. They plan for depreciation recapture, right? A cost segregation actually increases the tax rate on depreciation recapture on sale, so savvy investors line up 1031 exchanges or other deferral strategies to keep the IRS out of their pocket. And they keep building the portfolio. Each new purchase creates fresh deductions, right? And they often borrow against depreciated properties tax-free. In the end, many pass properties to their heirs with a step-up in basis, meaning no one ever pays tax on the built-in gains. In other words, anyone can generate short-term paper losses, but the real winners design their strategy so that the savings don't disappear later. They convert temporary timing benefits into permanent tax advantages. So here's the bottom line. Cost segregations can be powerful, but only when paired with the right planning around passive loss rules and long-term exit strategy. Okay, do them in the wrong situation and depreciation recapture can actually increase your taxes. And if you want to understand depreciation recapture so you don't end up increasing your taxes by following the advice of tax strategists, then check out the next video.